In this video, we're going to talk about the 4 options of owner financing. My name is John Adolfi with Adolfi Real Estate in Sleepy Village of Phoenix, New York. And we're going to talk about the 4 legal options of owner financing. Now, I'm going to give you an opportunity to get the free report. We're going to go over 3 of the 4 so that the report will give you a bonus way of owner financing in this given scenario. Now, let's say that you're a buyer that can't get a mortgage, but you've got a seller that's willing, but they have a mortgage on the house that you want to buy. You have every intention of moving in as the buyer, not an investor or anything like that. You're going to move in on. And the owner is really warm to this idea. Here are 3 of the 4 reasons or ways that you can, should the owner be warm to this idea of purchasing this home and them not paying off the mortgage in the process. Now, it is a little bit tricky and a little bit dicey, but in life, that's the way it is. And please understand that if you have any hesitation whatsoever, consult legal advice in order to understand all the ins and outs. Now, what I'm about to share with you is the collective understanding of experience in my 35 years in real estate, and I consulted an attorney, a real estate attorney, who actually wrote most of this report that I edited to include my thoughts and ideas in regards to it. So here's the scenario. Mr. Smith has a house with a $50,000 mortgage on it. Mabel Jones wants to purchase it, but Mabel is not able to go to the bank and get financing, at least not yet. Cleaning up the credit, what have you. But it is possible in order to get a mortgage sometime in the near future. And both of them are good with that. Here's 3 ways that they can sell it from Smith to Jones and do it legally. Legal option number 1. Legal option number 1 is that they take the deed, transfer it over in a sale, from Mr. Smith to Mrs. Jones. Mrs. Jones will be the owner of record. The deed will be in her name. She then begins to pay the property taxes, water bills, heating. Obviously, it is her home. It is in her name. But it's not paid off at the bank. So what kind of liability is involved with that? Well, Mr. Smith, who is the seller, would still be required to have that mortgage paid. Mabel Jones said, I'm going to pay that mortgage, and Mr. Smith has handed her over the payment booklet and said, here you go. That's one way to do it. Or Mabel can start making payments to Mr. Smith, and Mr. Smith can make the mortgage payment himself. Either way, the mortgage gets paid. Now, if the mortgage company finds out that the owner of record has changed, they typically have a clause in their mortgage paperwork that says that they can call the mortgage. What that means is they say, Mr. Smith, you transferred this to Mrs. Jones. We want the $50,000 right now. Now, that typically does not happen especially when you're continually paying the monthly mortgage. I mean, that's what the bank wants more than anything else. But if they were to find out, A, and 2, care, and 3, not want this to take place, they could call the mortgage. When they call the mortgage, what they're saying is if you don't pay us the entire $50,000 within a given period of time, they'll give you a deadline, then you need to sell the house and pay us off, or we're going to foreclose. That's right. So you got to be careful on this one, but as long as everybody is doing what they're supposed to be doing, it can work. Legal option number 2 is called an installment contract, or also known as a land contract. A land contract, the deed doesn't pass from Mr. Smith to Mrs. Jones in this scenario. What Mrs. Jones does is starts paying on an installment contract. It is a mortgage per se, and she begins paying Mr. Smith a prescribed amount that they have agreed on. Mr. Smith continues to pay the taxes, but will charge Mrs. Jones that fee, for the taxes, and Mrs. Jones will have to get her own insurance Mr. Smith will have to continue his insurance, so there'll be two insurances involved, and the taxes will be paid by Mrs. Jones, but Mr. Smith will be the one collecting that money from Mrs. Jones in order to make his semi-annual property tax payments to his local municipal collector. The mortgage is still in Mr. Smith's name. It never transfers over, nor does the deed transfer over to Mrs. Jones. So you could say it's a glorified rental agreement, but it's more than that. If there ever came push to shove and the legal, let's say a legal matter pops up where you find them both in court at odds with one another, the judge isn't just going to kick her out like a renter. Not necessarily. If it's early in the process, maybe. But if it's further along and she has what they call equitable title, it means that she's got money in this property more than just a couple of months of payments, which means that she does have title, but not the kind of title that transfers. It's a equitable or money title, meaning that she has a stake in this enough to where she just can't get kicked out. All right. But hopefully that ever has to go that far. But the one good thing about this scenario as opposed to the first one is if there is trouble, you can have them removed without going through a foreclosure if the judge allows it. All right, and it shows that the buyer is really negligent in this process and not just missed one payment and then paid it, but you're trying to take advantage of that. That's not going to necessarily happen. Legal option number 3. Legal option number 3 is a lease option agreement. It's basically a glorified rental agreement. What they're going to do is they're going to rent it from you. So there's no issue with the bank or title passing from Mr. Smith to Mrs. Jones. Mrs. Jones is not going to have the title in her name. What she will have is a rental agreement to where she is paying so much per month for rent. And then whether it's taken out of the rent or added on top of the rent. And so typically a portion of that monthly mortgage payment to Mr. Smith is going to be taken out and saved up, so to speak, so that reduces either the amount that she's going to be charged for the house or her down payment portion. So over the course of a year, 2 years, it may be $100 a month, $2,400 after the 2 years is over with is set aside for her, and that is deducted from the amount that they had agreed upon initially for the purchase of the property after a specified period of time. Now, that lease option could go on for 7 years, 1 year, 6 months, 2 years. Typically they go 2 years because a buyer that is in trouble or is having difficulty with straightening out their finances, i.e. their credit, usually it takes 2 years. It's not to say it can't be done sooner, but typically 90% of everyone that enters into this agreement because of poor credit, it's not going to be the first year that they're going to then go out and get a mortgage and pay you off completely, because that's the plan. Some people will go 7 years. I've heard of this where they go 7 years and then they convert it over to where then they hold a mortgage and title passes from point A to point B. In that scenario, this woman that did this hundreds of times, there was no mortgage. It was paid cash when they initially got the house, and when they sold it to, say, Mrs. Jones, it was free and clear for them to do whatever they wanted. But the cool thing about it is that they held a mortgage after 7 years of doing a lease option. That 7 years was kind of like a grace period, a period of testing to see whether or not that they are really going to do what they say they're going to do. That is the buyer. The buyer did, and so after 7 years they converted it and they passed title from, in this case, Mr. Smith to Mabel Jones. That's kind of cool. But again, the mortgage was completely paid off from the seller. It was free and clear when they did that scenario. And they did it very comfortably and easy without any threat of the bank calling the mortgage and all that. After that 7-year period or 2-year period, the buyer then goes out and gets a mortgage and pays Mr. Smith off. Title passes, and now it's Mabel Jones's house. Okay, so that is the 3 legal options of owner financing. This free report is available to you. Just go ahead and click the link below in the description and you'll be able to get it. And you'll be able to get option number 4, which is called the wraparound or piggy bank mortgage scenario. All right, I'm John Adolfi with Adolfi Real Estate. If you have any questions, we're at 315-695-6434. And if you think this kind of stuff is groovy, hit the subscribe button, the little bell, and I'll see you in the next video.